and welcome to this demo class on Certificate in Python for Quantitative Analytics. So the agenda for today will be, we will do a quick introduction. So I'll introduce myself quickly because I'll be the trainer for the program as well. I will walk you through the course structure. We'll also do a demo class as well. So that way we'll take a simple concept, we'll understand the concept first, and then we'll do some discussion and then the hands-on. So I feel maybe the first 15 minutes or so, we will have like a quick walkthrough of both the introduction as well as the course walkthrough, and then we'll focus on the real deal, the actual session. So the idea behind the demo class is it will give you an idea as to how an actual session happens. So as I mentioned, so I've spoken with a few of you as well on the phone, but so that way we do the concept first, followed by the hands-on, and then a few applications. So let's do that. Yeah. So let's begin. So my name is Amey. I'll be the faculty for this program. And my background is I come from the industry. So I've been in financial services for more than 18 years. And my experience is a mix of both consulting and banking. I do have a bit of software experience as well. So that was long back, just after my engineering. And in 2020, I founded FinQuest Institute and I founded my other venture, Expert Consulting, as well. So we do consulting under a separate trade name. So our training programs are specifically focused around quant analytics, risk management, quant finance, and things pertaining to treasury analytics and so on. We do career counseling for candidates as well who would like to transition to the BFSI space. And my industry experience and also the current consulting which I do is mainly revolving around the areas of model development, model validation, derivatives pricing, funds transfer pricing, and process reengineering. So these are like the main areas. Academically, I am a CFA, a CQF, an MBA in finance, and an engineering graduate. I've been teaching for a while now. So even while working full time, I used to go as a visiting faculty to a few places. I have a very long association with a couple of institutes, and I'm also a part of board of studies at a couple of private universities as well. So the board of studies and academic counseling role is more of an advisory role, whereby my inputs are taken from the point of view of aligning the course curriculum from an industry requirements point of view. So this briefly about my background, and I write a lot as well. My focus areas remain quant finance, capital markets. I would say not just Python for finance, but in general technologies for financial applications. So this is briefly about me. No audio. So others, are you able to hear me? So one of our candidates is not able to hear me, but others, okay. Om Prakash, can I request maybe if you could probably just maybe drop out and reconnect again, or maybe just try reconnecting your headphones in case there's a connection issue. Yeah, yeah. But thanks for the confirmation. Yeah. All right. So let's continue. So the name of the course and the course duration, I say approximately 35 hours. So that way, why I say approximately? Because then certain concepts can take time and a couple of hours here and there, we can always adjust. The sessions will happen on weekends. So Saturdays and Sundays, 2.5 hours. And the sessions will happen on the same Zoom platform. It's a very, very light platform and it's very easy to use as well. Every session gets recorded. It gets uploaded on the students portal as well. So that way you won't miss anything. No, so Om Prakash, we cannot hear you. If you're saying something, we are unable to hear you. So so guys, I'll just drop a message to Om Prakash on the chat. I think the voice is not going through. Okay, so I've just messaged him indicating that we are unable to hear him. Yeah. And again, the slides, slide content and the videos, they get uploaded on the students portal, which is accessible 24/7, and you can use both your handheld devices or laptops, whichever is convenient. Tools for delivery will be, so PowerPoint will be our main guide. I'll be using the digital whiteboard, so this one. So wherever I do these annotations, I do the digital whiteboard extensively, because then the thing is, all of the workings cannot be done on a Excel or a Word. So then that's why the whiteboards are very, very important. And of course, the Python IDE. So there are multiple IDEs. Today, I'll use one of them for the demonstration, but then later on, once we begin the classes, I'll suggest a few as well. There will be regular assignments. I would say rather weekly assignments for hands-on practice. And there is an end of the course project as well. Course completion certificates are given to candidates after the successful completion of the course. And I like interactive sessions. So we'll do the same today as well. So feel free to ask as many questions as you have. So maybe after every couple of slides, we can take questions. So either you can unmute and say, or you can maybe put it in the chat box and I'll answer all of your questions as well. And we tell candidates, yes, we'll do a lot of things in class together, and the hands-on assessments will also help you build that extra confidence. But then an additional actions which I suggest during the course. So I mean, I'll in addition to the assessment, I also tell candidates, okay, I mean, we have done one implementation in a certain manner. Can you try this the other way? So I give the approach as well, and that way it gives further clarity and confidence on model building. And I can assure you that even for our friends who might not have done programming in the past, no stress because does not have a very steep learning curve. The syntax, etc., will come naturally with practice. So that way, to be honest, programming and mathematics is very similar in that sense. The more you practice, the more confidence you get, and I can assure you, it is not rocket science. It is just telling the program that we want you to implement a concept in a certain manner. That's it. And prerequisites, basic familiarity with time value of money, and it will be a plus if you also know some basic ideas of capital markets. Not that it is expected, but if you know, it's an advantage. So before we begin with the demo session, in the next 5 minutes or so, can I walk through the curriculum as well? So I know many of you might have gone through the course file as well, but no harm in quickly running through this once again. So this file is hosted on the course page as well, which you can check out subsequently, and you can go through. But then, yeah. So there's a question: what particular in capital market? So Vishal, when I say capital market, maybe the basic ideas of maybe what's a bond, what are stocks, maybe basic ideas of derivatives. Nothing advanced, but just a basic idea and maybe how they're used. Even if you know that much, that is sufficient. But again, that being said, in case many times we also get candidates who come with a banking technology background who may not have much of a capital markets thing. So for our friends who may not know much on capital markets, don't stress. And that is something which we will study. And that's my job to help you understand. So if you know that, excellent. Otherwise, no worries. I mean, we'll handle it together. So the first few pages are the standard ones. So feel free to go through this later. I'll just drop this later on, maybe on email, or maybe I can drop it in the chat box now also. And we have our candidates all over. So we have had representation from all over the world, and candidates have benefited over the last couple of years since when we started this program as well. And we have had candidates with different academic backgrounds and with not just professional backgrounds, but different academic profiles also. And everyone has benefited from it. And from a career support perspective, and we have our own network as well, which we try to use whenever our candidates are looking out for a switch, or maybe they're looking for a new job, etc. So we try our best to support in the best way we can. Then the candidates' feedback, you'll get to see it on the testimonials page as well. And we have had representation from across sections of the industry: banking, NBFCs, asset management companies, treasuries, etc. So that way, I mean, you'll get to see all of these things as well. Yeah. Yeah. Now coming to the meat on the bone. So coming to the course syllabus. So module one, it's more about the fundamentals, because then sure, we are going to use a lot of Python and build some very industry ready models as well. But then before we do that, we need to know the quick idea of the Python ecosystem. So what is Python? What are data types? What are loops? What are conditional statements? And so on. So I would say module one will focus more on help us getting started. And I can assure you this does not take a very long time. Probably 1.5 session, that is sufficient for this, because then this is something we should try to do more through hands-on, because then to be honest, if you have to learn the programming part of a loop or a conditional statement, etc. When I say a conditional statement, I mean a if statement, etc. So we try to do a lot of hands-on, so that gives a lot of comfort to candidates. Then the first thing which you do from a finance specific point of view is bonds, because then bonds are something which are very fundamental for anything which one has to do later on in either quant analytics, quant finance, etc. So things like the concepts around bonds, yields, spreads, yield spread analysis, risk metrics, a bit of rates analytics as well. That along with all of the applications of these, because then sure, we learn the concept there, but I always make it a point to explain why we are learning that concept and where we are going to use it. So today also we'll do the same thing. When we pick up a concept, We'll understand the why part first, because then the why part is something which gives us a lot of inspiration to learn the how, which is the modeling part. So today also we'll follow the same thing like we do in all of our sessions as well. Then we have a module on options, so whereby we do option pricing exercises for using both trees as well as simulations as well. We do make a brief discussion on option Greeks, because then many times we have people who would be working specifically on risk management, and they would find it useful to have that discussion on Greeks and a little bit on volatilities as well. Now, if you see, there are many libraries in Python, so I won't be bombarding all the libraries in one go. We'll do it in a step-by-step manner. So that's why if you observe, I've mentioned a couple of them here. Maybe we could do something earlier than this as well. So then what we do is, before we are about to use a library, I generally do a small non-finance hands-on so that we get warm up to that library. And then we start using it for financial applications. So, so that way it will be a step-by-step, and we don't need to consume all the libraries together. We'll do it in a systematic manner. So this module on options. Then we have a module on trading strategies and portfolio management as well. So a few key trading strategies we'll try to build. And with Python, it gets very convenient as well. Optimizing the strategy and working on that also gets very easy. We do portfolio theory, so things like the efficient frontier or asset allocation ideas. How exactly do we convert the Markowitz concepts into an actual hands-on thing? There are certain libraries which are available in Python which support this. So how do we do portfolio management exercises? That is something which we'll discuss as well. Now, since we talk of trading and portfolio management, risk management is a given, isn't it? Because then without risk management, one can't survive, isn't it? In any activity, risk management is required. So if you see, not just now, but we have started touching upon risk concepts earlier as well. So things like bond duration, convexity, or option Greeks for that matter. All of these are risk sensitivity or risk measurement parameters. We'll try to learn them and before we do the hands-on for them in the actual sessions. Here we'll talk of another very popular industry metric called as value at risk. So our friends who are working in market risk management would have already worked on VAR, but maybe here we'll talk specifically from a certain type of the VAR model, and we'll also try to build a model for that as well. So that is something which you'll find very interesting, because then sure, you might have had large systems in your respective firms, maybe a large treasury system which does the calculation. But then if you're looking at a role in, let's say, model validations or maybe even a model audits or even model development for that matter, knowing these skills will be useful. So then we can actually build a VAR model from scratch as well. We do time series analysis because I personally feel that time series is a very important skill set to have. And I would say it is relevant even in this era of big data as well. Sure, we have all of these advanced stuff in machine learning, deep learning, and other things. But then I think time series carries its own importance. So we focus on ARIMA, and that way, how do you tune an ARIMA model? I give both ways. We do it the pure Python way, and we do it the shortcut way as well. And I give the pros and cons when you should use what as well. We have the idea on modules covering machine learning and deep learning also. So things like supervised, unsupervised learning, along with the implementations we do. So we do the conceptual discussions on many of these concepts before we practice our hands-on bits as well. We have data visualization. Although I've mentioned it here, we start using visualization much prior as well. Here I've just put it more formally, because then I can promise that data visualization with Python is extremely powerful. And even for our consulting engagements, whereby we have to put in certain charts in a consulting report, I prefer to use Python a lot. Sure, I mean, there are other data visualization tools, but I can assure you, once you get comfortable with Python, you'll be very fascinated by the flexibility which you get. So you can have line charts, bar charts, pie charts, heat maps, etc., which you can easily put into your client reports. They are actually industry quality. Next, we also work on databases through Python. Why we included this is because for our friends who would like to move into machine learning or big data in general, we cannot have Excel as a store of value. So not that we want to become a database administrator, but we should be able to work on databases through Python, because most of the times IT security teams will not give us direct access to database. They'll say, we'll give you read-only access, you use your programming tools to access the database, and then you do it. So that's why this module on working on databases through Python is something which you do. We do statistical testing, typically hypothesis testing, and here we focus more on non-parametric tests. So most of us have done hypothesis testing, but in a business as usual scenario, we end up using more of statistical testing, isn't it? So students t-test, F-test, etc. But then there are many, many other types of tests which we generally don't use as a business as usual scenario. But I'll talk of specific applications which I had encountered in my projects in the past, which actually forced me to learn non-parametric tests as well. So we'll talk about a few of them. I'll talk of applications and we'll do the hands-on as well. And of course, regressions will be something which you do because then that is something which we require all the time, isn't it? So be it a simple linear or polynomial regression, etc. And then we have the assessments, of course. Yeah. So I will. So let me do this. So I'll anyways begin with the demo session. We'll begin the actual conceptual demo session. But then in the meantime, if you don't mind, I can just drop this PDF in the chat window. You can save it at your end. You can read it at leisure. But for now, let's focus on the concept, shall we? So going back. All right, so let's begin. And we will begin a demo class on bonds. Now, the reason why I picked this topic is it's very, very fundamental. And this is something which we can discuss in the limited amount of time which we have. So even for people who have not studied bonds in the past will not find it difficult. So this will be beneficial for everyone who's doing the demo. And that's why I picked this topic. So we'll do a bit of bond pricing today. And it's very, very interesting. And I'll show you how you can build your own Python calculator for the same. So starting with bonds, many a times we call this as something which falls within the idea of fixed income, because then fixed income as an asset class is big, and bonds is one of the items within it. So the first question, when you think of bonds, what is the most simplest product which comes to your mind? The most basic one, which everyone knows. So a bond or maybe anything from a fixed income perspective. GSEC, okay. So Omkar, anything more simpler than GSEC? Something which absolutely everyone knows. And maybe they might have some of their own money invested there as well. FD, absolutely. Thank you so much. Yes. So I would say the most basic form of a fixed income security, which is like a bond. So yes, and GSEC, yes, government bonds, I understand, but we'll focus on FD because that's the easiest, isn't it? So I would say FDs or TDs, what we call as fixed deposit or time deposit, they are by far the most simplest of the lot when it comes to fixed income assets. So when we say bonds, we can imagine that it is a certain product which is going to give us, I'll assume a periodic payment of coupon. So that is going to give us a certain periodic payment, which we call as coupons. And then in the end, you're going to receive your face value back. So for example, let's say if you open a fixed deposit worth 100 rupees or maybe $100, and let's say your neighborhood bank is going to pay you 5% interest on this for 1 year. So then when you go back to the bank in 1 year's time, the bank is going to pay you 105. Of course, you'll do the tax adjustment, but that's not our concern, right? But then if you see, you're receiving a certain interest plus your base investment back, isn't it? So that can be thought of as the most simplest variety of bonds. So some of you have already pointed out other types. So government security is an excellent example. There are corporate bonds as well. So this actually gives us an idea that bonds are some instruments which are going to give you a certain specific income and a certain specific return, I would say. Now, we will be doing bond pricing today, yes. But then before we do bond pricing, I would like to hear from you. Why do market participants trade or invest in bonds? So can you think of certain points that attracts people to the bond market? So you can start putting it in the chat. I'll start writing it. Okay, so we have a couple of points. So one is risk-free investment. Okay, I will write risk-free investment, and I just put a small question mark on one side. I'll talk of that as well. Assured income, yes. Okay. Anything else? Any other motivations? Absolutely. Thank you so much, Om Prakash. Very, very correct. Yes. A requirement for banks, so that can be from your regulatory reasons. Yes, absolutely. Anything more? Can I add something? Can I say trading as well? Any other reasons whereby I mean one might want to trade or invest in bonds? We have had a few reasons. Yes, I mean repo. Yes. So Omkar, if you don't mind, can I just think of that under the gamut of trading? Okay. Can I also say diversification? dot, dot, dot. So then can I go back? I have a few points here. So I think a few of them will be reflecting here as well. Yeah. So one is certainly trading. So that way we have firms which have very, very large trading desks who trade fixed income. So that way you have specific guys who will be doing trading of government securities, corporate bonds, etc. It can be used for investment purposes. So let's say if one is looking for, let's say, a short term or maybe even a long term investment, you can think of a certain bond. You can purchase the bond, you can hold on to it, you'll receive a certain interest and final payment of your principal as well. Recurring cash flows, especially if you have a requirement whereby you need periodic cash flows to come in, bonds can give you specific coupons. Typically, 6 monthly is a very common frequency for bonds, and you will keep on receiving interest payments. Comparatively safer than equity. I put a question mark here because not every bond will follow this particular idea. Because then for GSEC, absolutely, they are much safer than equity. But then if you look at a bond which has a lower credit rating, so for our friends who are new to ratings, a credit rating is something which conveys the kind of riskiness which is there in the bond. So generally, a lower credit rated bond will be considered more riskier. So typically your government securities or well-rated corporate bonds can have a AAA rating, which is very, very safe. That's like the most safest of the lot. But you can have lower rated bonds, let's say, for example, a triple B or below. Now these start getting riskier. So then top quality bonds, yes, they are safer than equity, but a lower rated bonds, they can be riskier than equity. Regulatory purposes, as one of you rightly said, whenever bank has to park money into SLR. So SLR is the statutory liquidity ratio, which is required under regulatory guidelines. So banks are expected to invest money in government securities. So that increases the demand from a bank's perspective to invest in bonds. It can be used for capital raising as well. So for our friends who might have studied things like capital structure, etc. If you remember, we have the debt and equity, which is like a common mix, which is used. So this debt portion is something which can come through bond issuances. So company might want to raise a debt or equity. Again, depending on what is opportune, they might want to decide one or the other at a specific point in time. It can be used as collateral. Typically, collateral is something which you require whenever you're trying to mitigate your counterparty credit risk. Because then the thing is you want to mitigate your potential risk of default of your counterparty. Typically, your collateral can either be a cash collateral or a cash-like collateral. If it's cash collateral, that means you and your counterparty will exchange collateral on a daily basis, let's say at the end of the day. But if it's a cash-like collateral, rather than exchanging bank transfer of payments, you're actually going to exchange government securities, which can act as a cash-like collateral. It can be used for diversification. So then this is something which we typically study in portfolio management, isn't it? In portfolio management, they say that you should never put in all of your eggs in the same basket. That's the idea of diversification. And then can you think what is the most preferred technique to show diversification? Which is that statistical metric which you use to convey diversification? So for our friends who work in portfolio theory, you'll have it on your fingertips. So would you like to tell which is like that specific parameter, which is like a good indicator of diversification? CAPM, Sai Parikshit, is more from a cost of equity capital perspective. Something else. So this is something which you try to measure through the idea of correlation parameter. Duration, again, Om Prakash is more specific from the bonds risk point of view. So I'll look at something like a correlation coefficient, whereby, I mean, if you are able to mix up your equity, debt, and some other asset classes, then that way the overall risk of your portfolio comes down. Because remember, finally, we are working in a risk and return space. And if we are able to optimize our return for each level of risk, that is something which we prefer. And a bond mixed with other asset classes will have a good potential to give diversification as well. And as we know, the correlation as a parameter is like a range bound parameter, isn't it? It runs between -1 to 1. So that way, if you have a lower correlation or a negative correlation, even better, that has a potential to bring down your risk for each level of return. So that way, that can be one more motivation as well. And there was something in the chat as well on LCR. So can I just quickly see that point? LCR. Yes, yes. So regulatory stuff, LCR, NSFR will also require the GSEC investments. Yeah, yeah, yeah. Thanks, Omkar. Yes. All right. So is everyone okay with the idea, or is everyone now appreciating the fact why people would want to trade or invest in bonds, because then that will give us inspiration to learn bond pricing, and we can build our own calculator as well. Okay, and that way, I mean, the calculator which we build for now, it might look like a small standalone calculator, but I can assure you that has many, many further applications. So we will be building a bond pricing engine today, but then that output can be used for many places. You can use it for your capital charge calculations. So typically, if you're trying to calculate your market risk capital charge, you will need to know bond price. You can use it for your value at risk calculation as well. So if you're measuring the VAR of a bond portfolio, you will want to know bond pricing. Next is you need it for your daily portfolio reporting as well. So be it MIS reporting or be it regulatory reporting. That's again places whereby we will need to know what's the value of a bond. That's why the calculator which we developed today, although it might look like a small calculator in isolation, it has many, many applications otherwise as well. And as Om Prakash has pointed out, even duration is one place whereby bond pricing will be required. So that way, although we do a small implementation today, it has many, many such applications otherwise as well. Yeah. And we are going to rely today on basic idea of time value of money. And we know the relation, isn't it? We have the future value equal to PV into 1 plus R raised to T, whereby you have T is some point of time in the future. So quick question, is this discrete or is this continuous? Because there's another way in which you can write this as well. It's discrete, absolutely. Thank you. It is discrete. You can write it in the other way as well, whereby we say FV equal to PV into E raised to R. So the first one is a discrete representation, and then this is a continuous. So I say discrete time and continuous time. So the good thing is all that you require for our today's discussion is plain TVM concepts, nothing more. Future value, present value, a relevant interest rate, and time. That's it, nothing more. Yeah. A few common features of bonds. We'll go through this, and then we'll discuss a little bit of bond maths, the basic maths, nothing complex. Now, for any time you look at a bond, right, the main features which you need to be familiar is who is the issuer. So your broad classifications can be sovereign bonds. Sovereign bonds are also what we call as the treasuries, or many times we call them as government securities, GSEC. Non-sovereign bonds can be, maybe an example can be a municipal bond, for example. Or in India, we have something called as a state government security, an SGS for short. That can also be thought of as non-sovereign, because although it's backed by the state government, it's not the central government, isn't it? So many times we might want to call it as a non-sovereign bond. We can have corporate debt, i.e. anyone which is like a company, let's say a bank bond or NBFC bond or anyone else. So basically non-government bonds. So these are corporate. And supranational issuances, which are generally big in size. So these can be bonds which are issued by, let's say, IMF, IFC, World Bank, etc. So these are the issuers. So that way, anytime we look at a bond investment, we should know who the issuer is, because then naturally the question which we try to answer is, based on who is the issuer, we try to understand what is the source of our receipt of cash flows. Because then if a government issues bonds, then tax receipts which government takes from us, that is something which they will use to pay down the bonds. So that can be a source of income. If it's a corporate bond which you purchase, your source of income will be the business income of the company whose bond you have purchased. So let's say if you have purchased a bond of a manufacturing firm, then the manufacturing firm will manufacture products and they will sell it off to their counterparties or maybe their trading partners. And when they get the cash, they will use to pay down the bonds. So the issuer will also help us point to the direction as to what will be the source for our cash flows on the investment. Then based on the coupon, so today we'll focus on the fixed rate bond only. So when you say a fixed rate bond, it can be like a bond which pays a fixed rate of, let's say, 5%. A floating rate can be linked to any floating rate reference. So for example, I can take an example of SOFR, secured overnight funding rate. So your floating rate bond implies that a coupon, which otherwise is fixed, that will be linked to some floating reference. So as the floating reference changes, your coupon also changes. And then we have deep discount bonds called as a ZCB or a zero coupon bond. So that way, as the name goes, a zero coupon bond does not pay any kind of coupon, which will be 0%. And that way, for our friends who have already studied ZCBs, They know how the ZCB prices are going to move. Typically, for our friends who have not worked on ZCBs in the past, remember that if you are to issue a zero coupon bond to the market, you should always be issuing it at a discount. So what do I mean by that? Because then typically in the market parlance, you will hear the term trading at par, trading below par, and trading above par. So that way, if I say the face value of the bond is 100, then trading at any price which is below 100, let's say, for example, a 95, this is called as trading below par, or it's also called as trading at a discount. And let's say if it's trading at a price more than 100, which is more than the face value, we also say that it's trading above par, and we say it's trading at a premium. So that way, if you look at a zero coupon bond, it always gets issued at a discount, because the promise is, let's say, if the time to maturity of a ZCB is 1 year, and if the bond is issued at, let's say, 98 on a face value of 100, so the investor buys the zero coupon bond at 98 today, and if they hold on for 1 year, then they're going to receive 100 at maturity. So that way, the additional 2 units, 98 to 100, that is there to compensate the investor for the interest income. Because a zero coupon bond will not pay a coupon. Whatever coupon you receive will be in the form of a price appreciation. That is, you buy it at 98, you hold on to it, you receive 100. So that 2 units of cash will make up for the interest. Then frequency of payment. So for our friends who have worked on bonds, what is the most common frequency of payments which you have come across? Uh, Semi-annual, absolutely. 6 monthly. So 6 monthly is the most common frequency out there. But then you have other frequencies like 3 months, 1 month, 1 year, etc. But 6 months is the highest in volume. Also, based on the maturity date, you have a broad classification. So that way, if your bond maturity is less than 1 year, you say it's a money market product. If your bond maturity is more than 1 year, we call it as a capital market product. You can also have bonds which have optionalities. So that's why we call it as bonds with embedded options. So an example of this, we'll not do this today, but then you have a callable bond or maybe a puttable bond. All of these are like examples of bonds with optionality. So it's like a mixed product. Absolutely. Yeah. Thanks, Omkar. Yeah. Callable. So callable and puttable implies that one of the parties, either the issuer or the investor, they have the option. When I say embedded option, that means you have actually two components. You have a bond plus you have an option. So it's like a mixed product because you have something which is a cash instrument, which is the bond, plus a derivative, which is an option. And then structured bonds, now to be honest, for structured bonds, sky is the limit, because then the word structured itself is so flexible that it depends on which type of bond you are looking at. And I can assure you that if you look at exotic structures, there's no limit to it. As long as you're able to find a counterparty who is willing to trade with you, you can always have a structured bond on the books. So these are like the main features which one looks at. There can be a few more ideas, like maybe what are the bond covenants and other things as well, because then that is something which every investor will look at also. So I would say later on, if you get a chance, generally check out what we call, so any bond which trades in the market, you can download what we call as the bond prospectus. Now, for our friends who have worked in bonds already, they know this. But then for others, for any traded bond in the market, you can download the bond prospectus from Google. It's an open source document because that's a compliance requirement. Every bond which trades publicly, the issuer has to publish a prospectus. Now, within prospectus, you'll have one section which talks of offer details. So this is a small page. Offer details could be barely 1 or 2 pages. So it will have things like who is the issuer, what's the face value, what is the coupon, what is the frequency, what's the credit rating, etc. All of those things will be mentioned in the offer details. So I'll say generally go through this, because later on, if you're working on roles whereby you're expected to do, let's say, bond valuation, let's say if you end up in one of these consulting firms which does fair valuation exercises, you will be expected to know the bond prospectus. When I say know, not by heart, but you should know what to look at on the bond prospectus. Because many times you guys will be supporting audit teams. So if you're valuation experts, you'll support an audit function to give them comfort on the valuation of a bond product. So then your client might have issued a bond and they'll say, can you please do the fair valuation for us? So then your audit team gets in touch with you, you're a valuation specialist. So at that time, they say just go through the prospectus and give us a number as of, let's say, 31st of December, for example. So for that purpose, if you go through the prospectus and know what to look at, I think that will be an advantage. So do check this out. This is something which you'll easily get on the internet for any bond which trades in the open market. Yeah, so any thoughts, any questions on this or the previous slide? Anything which I need to go through or anything which you would like to add further as well? Okay. So shall we do a little bit of foundational bond maths so that we can actually use this as a part of our modeling work as well today? So YTM, by far the most popular of the terms when it comes to yields. So when you say YTM, it stands for yield to maturity. So a quick question. So especially for our friends who have done bonds in the past. Uh, so what are the two assumptions which are required to earn the YTM? So two conditions which if you meet, you're assured that you will earn the YTM return on them. Yes. Anyone who would like to give it a go? If you have read it in your previous readings, maybe. Okay, there's something in the chat. Let me go through. Yes, hold the bond till maturity. Yes, yes. And there's one more condition and reinvestment. Absolutely. Thank you so much. Yes, yes. So we have three, four responses. Bang on. Yes. So that way, two conditions which are needed to satisfy that you earn the YTM return on the bond is that you hold the bond till maturity and you all of your periodic cash flows which you receive on the bond, they are also reinvested at the YTM. So as long as we follow those two assumptions, we are expected to earn the YTM return on the bond. Now, you might have heard of the term yield curve in the past. Yeah. So when you say a yield curve, it's a simple plot of tenor versus yields. So that you can have tenor of, let's say, 1 week, 1 month, dot, 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 up to 10 years, or even more as well. And then for each, you have a certain yield, which will be some percentage points. And this is what we call as a yield curve. You can get this data from many, many market sources as well. So in India, we have either the FBIL or FIMDA, or otherwise for our global participants, you might procure this data even from Bloomberg or Refinitiv, etc. Uh, so when I say a yield curve, think of this as a simple two-dimensional plot of tenor versus yields. Yeah, and Omkar has given a few examples as well. So how do we interpret that? So maybe Omkar, I'll probably show a normal yield curve, the growth yield curve, the nice picture. So because then inverted is something which we generally want to avoid from a markets and jobs perspective. So let's stick to the usual one. But Omkar is right. I mean, there are different shapes of the yield curve. But for now, let me just show you like a textbook yield curve, which you always see. So for now, imagine that you just have four bonds which trade in the market. Then all that I do is I go to the market, I fetch the maturities for the four, I fetch the yields as of end of the day for the bonds, and I plot this. So let's say these are my four yields, for example. Let's say one year, 2 year, 3 year, and 4 year. And if I combine all these in a smooth curve, this is what we call as the yield curve in the market. And that way, this can extend right through till 10 years, 15 years, etc. Now, also many times there is a term benchmark yield, which we hear as well, either in literature or even in news articles. So then every market has a certain benchmark security. So then for our friends in India, would you like to say which is the benchmark security? And for our global participants in your respective markets, can you tell me which is your benchmark security? Because that is something which is heavily tracked by almost every market participant. So when you say the benchmark yield or the benchmark security, that's like one specific security which we look at. Yes, yes. Uh, Correct. So they are government securities. So GSEC is correct. But then if you ask me from the Indian markets, then 10-year GSEC is the benchmark security which we have. And that is something which is very, very closely tracked. Yeah. So yeah. Thanks, Cyber. Yes. US 10 years as well. So I think even in the European markets, typically in Germany as well, you have the German bonds, which are for 10 years, which are like the benchmark. Now, although they give a representation of one specific point on the yield curve, they are something which are heavily tracked because I understand that different sections of the yield curve will respond differently to the demand and supply forces. But then the market participants will always like to track the benchmark yields because that gives a fair idea as to how exactly the market is moving, and that gives a fair sense of where the interest rates are headed. And that's why you'll observe that benchmark yields are something which are always published for that respective benchmark security. Now, a quick question. Now, this is like those icebreaker questions which an interviewer asks at the start when they're flipping through your CV. So, benchmark yields, are they real or are they nominal? Any thoughts? So, so let's say you have a 10-year GSEC yield. Do you think it's a real yield or is it a nominal yield? Okay, we have one response. Anyone who feels nominal. Okay, so it's actually nominal. I'll tell you why. Because then there is a relation which says that R nominal is equal to R real plus the expected inflation. So that way, remember that the yields which are quoted in the market, they are always nominal yields. Because then if you see, for example, if I take the example of a Indian market, now our 10-year GSEC rate, let's say it's I just take a ballpark number, let's say around it's 6.5. Then that is the rate which I directly use in my calculation. I will not make a separate inflation adjustment. So I won't add a 4% CPI number on top of it. No. The idea is the yields which get quoted in the market will already have the inflation expectations which are embedded inside them. And that's why we say that the yields which are quoted in the market, benchmark yields or otherwise, they are always nominal yields. So does that sound okay? Is everyone happy with this? And any questions in the first four bullets? Okay. Uh, we will look at these three bullets in one go so that we are in a good position to do our hands-on as well. So with your permission, can I just switch to the whiteboard? It will be a little easier and it will give me more space to write. And this is something which I use extensively in the live sessions as well, because then all the workings which I do, I prefer to do it here because then the space is also more, isn't it? I can do a lot of discussions. So I will talk about bond pricing and I'll write a simple formula. So that way the formula is pretty straightforward, but then we have to also write a Python model for this. And I'll tell you the logic which we are going to follow. So let me take a simple bond. Let's say a bond which has a tenor of, let's say, 3 years, which has a face value of, let's say, FV. Let's say a coupon of, I'll say C. Let's say the yield to maturity is a Y. Frequency, if you don't mind, I'll just keep it simple. I'll keep it as 1 year for now. I promise that when we do our hands-on bit, we'll keep it very, very flexible. And that way our bond will be able to handle other frequencies also. This will just make my writing easy. So that's why I'm keeping the frequency as 1 year. And we are interested in the bond price. Yeah. So the standard equation which you can use to price a bond is given as like this. It is just application of time value of money. So I'll write this and then let me know if you want me to run through any of this. Let me just explain this briefly as well. So that way, for our friends who may not have done bond pricing in the past, this is what I'm trying to show through this equation. 0, 1 year, 2 year, and 3 years. Yeah. So let's say you're standing here. We know that the coupons which you receive at the end of each year is equal to C. And then in the end, you're also receiving the face value back. So when we are doing bond pricing, so other names which you give to this is fair valuation, MTM, bond valuation, or bond pricing. Almost all of them will have a similar connotation. So that way the meaning still points that is the PV of the bond today. That is how much the bond is worth right now. When I say right now, today. So assuming I'm standing here, I want to calculate the bond price. Then all that I need to do is I need to look at what are my cash flows which are expected at different points of time in the future. 1 year, 2 year, and 3 year heads. And since I'm standing at this point, I'm going to leverage the idea of time value of money. That is, I'm going to bring all of these cash flows back to today. When I say bring it back to today, as you must have guessed, I'll have to apply discount factors. That is, I'm going to have to present value all of these further cash flows so that I can bring them to today. I can sum it up and I have the bond price. So that way, this is the pictorial representation. And from the equation perspective, it looks like this. So this is your 1 year cash flow, 2 year cash flow, and 3 year cash flow. And if you see, if you just focus on this, this is very, very similar to the idea of calculating the PV of your cash flow one. How? Because this coupon, if you don't mind, can I just write this as C1, C2, and C3 so that I can just write this separately? So that way, if I look at C1, C1 is something which is due in 1 year's time. But then I want to know how much it is worth now, isn't it? So I take the coupon, I divide it by the yield. That is, I'm discounting this, isn't it? And that way, this allows me to figure out what's the PV of my first cash flow. Then I do PV of my second cash flow, and then the PV of the third cash flow. So in general, is everyone happy if I say that a bond price is nothing but a PV of all of your future cash flows? So does this look fine? Is everyone okay with this? Okay. And then, as we know, bond price and yields move in an inverse fashion, isn't it? So there's an inverse relation. Because then typically you come across news articles which say that as bond yields rise, bond prices fall, and vice versa. So that's why for plain vanilla bonds. So what we have discussed now is a plain vanilla bond. There can be other complex varieties which we'll not do in the demo class now. We don't have that much time. Neither do we have that preparation for that. We do the simple stuff. So we have the bond price versus the yield. And because of this, we say that it's an inverse relation. And that is very evident from the equation as well. Because if you see, the yields are in the denominator and the price is in the numerator. So that way, if the yields are rising, that means I'm dividing by a larger number. So that way, the bond price is going to drop. And if the yields are falling, that means I'm dividing by a smaller number. So that is going to result in a rally in the prices. So that's why we say that price is inversely proportional to yields. So are we good with this? Because we want to implement this in Python now. Again, our calculator will be able to handle different maturities, different coupon frequencies, etc. We'll keep it very flexible. Yeah. Okay. So let's go back. We'll talk of credit spreads in a bit. We don't require it immediately, right? We have to develop this. We have to build this calculator in Python. And we have to make it very flexible because remember, this calculator can be a part of your bigger treasury infrastructure. And you might want to use it for a variety of applications. A few which I mentioned at the start, just reiterating. Capital charge calculations, daily portfolio valuations, stress testing, bond risk sensitivities, your any kind of MIS reporting, expected shortfall, etc. All of them are going to require the bond pricing numbers. And that's why having a flexible calculator is important. The idea is you write this code once, and that way it should be able to tackle every single bond in your portfolio. So we can do this repeatedly. There's something called as a loop as well. So there's a way to do that. Now, I will tell you the approach which you are going to follow, right? So we are going to define what we call as a user-defined function. So we are going to define our own function which will do the calculation for us. So for our friends who might not have worked on programming tasks in the past, so you might have a question of what's a function, isn't it? The most simplest way to understand this is when you say a function in plain English, that means it's a set of logic which you're trying to define in order to achieve a certain objective. So all of us are familiar with Excel, isn't it? So remember in Excel, you have something like a sum function. So let's say I do equal sum equal to 1, comma 2 in Excel. So then I know the moment I do this, the result is going to be a 3. So you can imagine that this is a function. This is like an inbuilt function in Excel. So one can imagine that your logic of addition of numbers is embedded inside this function. And there is one more technical term which you come across when you start building models or start programming. These are what we what we call as inputs. So in layman terms, we call them as inputs, isn't it? Now, in technical terms, these are called as something. So for our friends who have done modeling in the past, do you remember technically what do you call these numbers in the bracket? So it's called as function dash. So there's a specific technical nomenclature which we give to this. So for our friends who might have done programming or maybe engineers in the current session, you will have heard this term. So these are called as arguments to the function. So just a technical name. When you say arguments to the function, these are going to act like inputs to the function. So we are going to create our own function and we'll also pass a set of arguments. When I say arguments, these are the inputs which I want the function to handle. Yeah. Then we'll use some looping. I'll tell you why we'll require looping as well. I'll show that working on the whiteboard before you do the calculation. And then we'll use a conditional statement. We are going to require it. So when I say conditional statement, think of it like a if statement or if then kind of a thing. This if condition is very similar to what you do in Excel. So remember in Excel, we do equals if certain condition, then do something, else do something. So we can think of it something like this only. And then we bring it all together and we can calculate a bond price. So let me show this on as to how we can actually accomplish this. So can I write our good old 3-year bond once again? Because then I'll show you these steps, how they match exactly. And I have a certain logic in mind, which I would like to implement, and I'll show you what it is. So I'll take the same 3-year bond, which I've written on the whiteboard. So the left-hand side is what we intend to calculate. And let me write the right-hand side. For now, let me just write this as the annual coupon paying bond so that I don't need to make adjustments. I promise that we'll keep it very flexible in our actual calculator in Python. Plus, I write the face value separate. And there's a reason why I'm writing it this way. Because if you see earlier, I had written the last coupon plus the face value together, isn't it? Now here I'm writing it, sorry, it's not raised to 4. My apologies, this is raised to 3. It's a typo. This is a 3. Yeah. So now if you see, you have the cash flows which are appearing at 1 year, 2 year, and 3 years. Just that the last cash flow, I'm planning to split into 2 parts. I can do that, isn't it? I'm just separating the numerator. I'm keeping the denominator as it is. Now, the way in which I visualize to keep it simple, let's combine all the coupons together and let's run this inside a loop. And let's have this outside the loop. I'll tell you the reason behind it. Now, when I say a loop, that means you're trying to repeat a certain operation over and over again. So remember when you say that you're listening to your favorite song in a loop, that means you're running the same song over and over again, isn't it? So this loop also means the same thing. That means you're trying to do a repetitive operation over and over again. And we just tell the program how many times we want to run the operation and which operation we want to run. Now, why I'm writing it this way? Because if you see, coupons are something which are going to appear periodically, isn't it? Coupon will appear at 1 year, 2 year, and 3 year. So it will be like a repetitive activity which is happening. So I would like to handle that inside a loop. And then the final face value, that is something which is appearing only once at maturity. So that is something which I'd like to keep outside the loop. And that's why I say, let's have the coupons together inside the loop and let's keep the face values separately. And then we do this. So is everyone okay with this? We'll see how to write a Python model for this, but then does this sound okay? And any questions? Any questions, feel free to ask. I'll be happy to explain again. Okay. So next what I do is I'll go to something which you call as a Python IDE. So IDE is called as an integrated development environment. Just a big technical name. You can imagine it's just a canvas or a platform on which you're going to write our things. That's it. There are many, many such platforms. I'm going to tell all of these platforms when we do our live sessions. For today, I'm going to use one specific such platform. It's called as PyCharm. So that is something which I use very extensively for my client engagements as well. And there are a few advantages to that, which I will demonstrate as well. So with your permission, can I switch to that other screen whereby we'll try to build our model? Yeah. Okay. So this is what we call as, so this is the PyCharm IDE. And what I've done is I've just created a fresh file for us. Yeah. So that way it's a fresh and a blank file which I've just created before the class. And this is where we'll write our things. Yeah. And you'll observe that anything which you write in Python, it will be .py or it will be .ipynb. So what that means, we'll again discuss later. For now, you can imagine this is the place whereby you can write your Python. Yeah. So now, as I mentioned, for this, we are going to define our own function, isn't it? And the advantage is once you write a function, everything is embedded inside that function. And you can call the function from anywhere. So let's say I write the function here. Let's say one of my colleagues wants to use this function, they can call the function and they can use it at their end. So if you see, that brings in a lot of reusability of code and that helps you make it very efficient. Because remember, in a project setup, you're expected to complete the project on time. That's one, but you're also expected to make the project profitable, isn't it? So if you can bring in more and more efficiency into the way in which things operate, you can speed up things, you can have better quality of deliverables, and that way your not just your project profitability, but your client reputation also improves. So that's why we write things like functions so that it's very, very reusable. So shall we define a function for ourselves? Now, I'll be following a certain syntax. Now, for those of you who might have done Python in the past, you might get a hang of it. For others, I promise, don't be bogged down by the syntaxing. I'll walk you through the steps anyway. But then for the syntax, that comes with practice. Maybe in a couple of weeks, once we start doing things together, that comfort will come. Yeah. So let's define our function, shall we? And I say, let's say define a bond price. So this is my function name. My function name is bond price. Now remember, I had mentioned the technical word as arguments to the function. Now, if I want to do bond pricing, I have to pass a certain set of inputs. So imagine that the left-hand side is the P, bond price, which I want to calculate. On the right-hand side, I have a certain set of inputs. Namely, I'll say face value, time to maturity, coupon, yields, and frequency. And then in Python, the standard way to do this is you always end this with a colon. Now again, why the colon, why the indent? That is something more on the syntax part, which we cover in detail in the live sessions anyway. For now, we just assume that this is the standard syntaxing. Yeah. Now, the first thing which I'd like to do is to count how many number of periods which are there in my bond. So for example, if I take a 2-year bond, assume a 2-year bond which pays 6 monthly frequency. That is, there'll be 4 cash flows. My bond maturity is 2 years. So I have my cash flows every 6 months. So 6 months, 1 year, 1.5 year, and 2 years. So I would like to make a count as to how many number of cash flow periods are there. So that's my first thing. So let me say number of periods is equal to. So that will be my total time to maturity into the frequency. So this will give you 4 periods. Now later on, I'll show you how to debug the model because then we can actually step through as to what all we are doing and how it gets executed. So hang on to it, we'll get there. But then this will tell me the number of periods. Now the coupon and yields which we are passing, I'm just thinking of passing a number. So let's say I assume the coupon as 5% and yield as 5%. Now finally that 5% should be read by the program as 0.05, isn't it? So then I'll just make a small division by 100 adjustment here because the number which I'll pass is a 5. So then we'll just make the adjustment here. So I say coupon is equal to coupon into the face value. So let's say if my coupon is some percentage, it's always a percentage of face value. So for example, if you take an annual coupon paying bond and it says that your coupon is 5%, remember it's always a percentage of your face value. So 5% of face value. And that's why we are doing a coupon into FP. But remember, we want to keep it very, very flexible, isn't it? So firstly, division by 100 comes in because our coupon will be passed as a number, 5. So it's 5%. So 5% is 5 divided, so it has to be 0.05, isn't it? So that's why division by 100. And I want it flexible, so I keep a frequency. This will get adjusted. Because remember, if your coupon is 5% annually, and if you're following a 6 monthly payment cycle, that means you're going to receive 2.5 units every 6 months. And that's why we divide this by frequency. Yeah. Similarly, the yield which I will pass is directly a number. Let's say I pass the yield as 5. It is 5%. So I just adjust it for that division by 100. So I say y equal to y upon 100. into the frequency. This will need to be adjusted as well, isn't it? Uh, I'm just contemplating creating one variable. So with your permission, can I just switch to our slide deck? I'll tell you what I have in mind. So now if you see, I'm planning to run this inside a loop, isn't it? So that way I'm going to calculate the PVs of coupons one after the other. When I say a loop, it is like a repetitive operation. So in the first run of the loop, I will handle, so let me just switch inks. So in the first run of the loop, I handle the first coupon. In the second run of the loop, I handle the second coupon. In the third run of the loop, I handle the third coupon. So then if you see, it's like a repetitive task, isn't it? And I want to somehow keep a track of all of my earlier coupons because the thing is, if I don't have a track of it, I will not be able to record these coupons. Because remember, if I'm running the loop every time, then it is overwriting my calculation, isn't it? So that way, if I am on coupon number 3, and if I don't make any provision to save these earlier 2 coupons, they will get overwritten. I don't want that to happen. I want to keep a track of that. Yeah. So then in that case, I'm thinking, let's have a temporary coupon counter. That is, let's have something like a temp coupon, which will be like a running counter. So that way, every time I run the loop, I will keep on storing that inside temp coupon. So that way it will keep on updating. So that way I have a track of all the 3 coupons which are there, which I can then use in my final bond price. So does this sound okay? And is everyone convinced that we are going to require a certain variable to hold respective PVs of coupons? Otherwise, they'll get overwritten. Yeah. So we'll try that. So let's say I say temp coupon equal to 0. And generally, a best practice is whenever you create a new variable, assign it a value of 0. So that way, if you see this is a new variable, temp underscore coupon, I am assigning it a value of 0. Now, the next thing which I'm trying to do is I'm trying to pinpoint the location at which my cash flows are going to come in. So let's say, again, I take the 2-year bond with 6 monthly payments. I would like to tell Python that the 4 points at which I'm going to receive the cash flows are 6 months, 1 year, 1.5 year, and 2 years. And I would like to save it in a systematic manner so that once I know the exact time points at which my cash flows are coming, all that I need to do is just pinpoint to that location and do the PV. It's as straightforward. So I'll show you. The syntax might look a little different, but then I'll explain you what that is. I plus 1, sorry, this divided by frequency for I in range, number of periods. So let me just write a couple of more lines and then I'll do a detailed step through so that you understand what exactly is happening. Just for now, you can imagine that this DT will be like a array or like a group of items which is going to hold the 4 points at which you're receiving the cash flows. 6 months, 1 year, 1.5 year, and 2 years. Once we have this, we can actually start visiting each of those time points and do the PV of our cash flow. So that's where our temporary coupon counter is going to get used. And as you must have guessed, this is something which will happen through a loop because now it's a repetitive task. My coupon is appearing every 6 months. So I have to keep on repeating it all the time. And when you say you're repeating something, all that you need to do is a loop. I will prefer to use what we call as a for loop. So a for loop and a while loop, these are 2 popular ways of looping. I'm choosing to use the for loop here. And I say my temp coupon equal to temp coupon plus I want to PV my coupon, isn't it? So which is equal to coupon upon 1 plus the yields raised to. So I'll tell you what this star star means. So the star star means it's raised to, because remember in Excel, when you have to say, let's say x squared, you say x kappa and 2, isn't it? Now the kappa notation does not exist here. Star star notation says that it is raised to something. Yeah. And then I can just have my bond MTM, or should I say bond price if you do. So bond price equal to temp coupon plus the PV of my face value. And in about a couple of minutes, I'll actually do a walkthrough so that we can convince ourselves that what is happening is correct once we get this working. So just one more line to go. And I'll tell you why that additional line is required. Okay, and we return the price. So what you have written here is a simple function definition. That way, this is going to do the calculation. I'll show you how this happens as well. But remember that function definition is one thing. You have to also make a call to the function, isn't it? So let's say making a call to the function, that is, we are telling Python that we have this function. So please execute this function on our behalf and give us the result. So then there's a standard way to do that. So for now, the syntax will appear different to you, but then don't stress, it's a standard syntax. If is equal to, so if you see, this is like a natural syntax which brings in this play. Now, don't stress about the syntax right now. We are almost there. Yeah. And I say bond MTM equal to bond price. And let's pass our input, shall we? So let's say face value of 100. Time 2 years. Let's say coupon of 5%, yield of 5%, and frequency, we'll keep it as semi-annual fund. We can keep it flexible. Let's keep it as semi-annual because we did all the discussion on semi-annual, isn't it? And then can we just print this? Okay. And with your permission, can I run this? And then I'll do a walk. Just that we get the answer correct first. It is 100. Good. And why I say this is correct? Because remember that when your bond coupon and bond yields equate, your bond will always trade at par, i.e., it will always trade at face value. And that's why the calculation is correct. Now, just to convince ourselves that we have actually done this correctly, I will show you how you can do a walkthrough. So there is a technique called as debugging the code. And I say it's a very, very important skill set to be able to debug things. Because if you see right now, we have just run the code, isn't it? But then we also want to test if Python is actually following the same logic which we have in mind, isn't it? And for that purpose, a debugging idea is required. So when I say debugging, it's actually doing a step through. So I'll tell you how to do that. So what I introduce now is called as a breakpoint. So, and then I start a debug. So when I say a debugger, that effectively means that your code is going to come and stop here. So let me show you what happens. Now, if you observe, program control has stopped at this point. It has not executed fully. Now, the benefit is you can actually see a lot of things. So let me attract your attention to two things. One is you see all these numbers in gray. So these are the inputs which you have passed. Yeah. And the next one is a variables window at the bottom. So if you see, this is something which will start getting updated as we do the calculation. Now, let me step through into the model. So if you see, the number of periods which is calculated is 4. How? You have a tenor of 2 years and a frequency of 2. So that way, 4 cash flows because 6 months, 1 year, 1.5 year, and 2 years. So that's why 4 coupon periods. Then how much is the value of the coupon? You get to see here. So if you hover on this, you get the coupon of 2.5, which is correct because it is 5% annually. So it will be 2.5% every 6 months. Same thing gets reflected in the variables window as well. Same thing for yields. I adjust the yields appropriately. So my yields are also 2.5 because I'm passing the yield as 5%, isn't it? My temp coupon is the temporary variable. And now if you observe, as I mentioned earlier, I am actually able to tell Python that these are the 4 locations at which my cash flows are coming. And then I'm going to instruct Python that please go to all of these locations and do the PV calculation for me. So that way, this is also what we call as an array of data or array of numbers. Array is nothing but a collection of data items. Here, if you observe, it's a collection of our tenors. Yeah. And now, if you see, there are 4 points. So now this for loop needs to run 4 times. So let's try this. This is 1. Now, if you see very carefully why the temp coupon has been added. Now, after the first run, if you see, your temp coupon is 2.43. That is, this is the PV of your first coupon. Now, I run this again, the second run. So now if you see, your temp coupon will get updated. Why? Because your PV of coupon 1 plus PV of coupon 2. Then we have PV of coupon 3 and coupon 4. And now this will exit. So now if you observe, if you hover on this, your temp coupon will be an addition of all of your 4 coupons, the PV of all your 4 coupons, which is 9.4. And then you simply have the PV of the face value, which gives you the price of 100, which is the correct answer. And then the control exits. And this stops your debug. So syntactically, that comfort will come with practice. I assure you of that. But logically, does this look okay? And any questions on this? And that way, as we start building more and more models together, that confidence will come, because this confidence will play an immense role when you do things like model enhancements, model risk management, and so on. Because I can say with personal experience that, especially when you look at client models, right, and clients are paying you, many times it happens that you develop a model for a client, and then the client says, we'll give you an annual maintenance contract, and you maintain and enhance the model for us. So that way, once you have customized the model for them and then you maintain it, it becomes very easy, because then you have actually done the stuff yourself. So these skills come very useful, and then you can make any kind of enhancements which you like. It's not difficult at all. I can assure you that. And once we do our practice together, so once we do things in class together and you do the practice assignments and the project, you will get very, very comfortable on applying Python for a wide range of financial applications. Okay, so we go back. So we are going to develop such models together in class. So for our friends who have never done programming, don't stress. It's a very systematic task. And if you see, we have literally broken down the thing into parts and we have done that. It's not difficult, isn't it? It's just implementing things in a certain manner. So that way, just to summarize, the batch begins from 4th of April. It will be done on weekends, so 2.5 hours every Saturday and Sunday. Uh, that way, you can get in touch on the below coordinates if you have any further questions, further queries which you'd like to discuss. If you love the demo and if you're convinced that you would like to join in, which I hope all of you have liked and hopefully you'd like to join in, you can just visit the course page directly, or even scan the QR code here, and it will take you to the course page wherever you can sign up. So that way, we have already started receiving signups, and that way, the good thing is Python is open source. So then you don't need to purchase any licenses as such. All that you require is just your laptop and a Wi-Fi connection. And otherwise, we'll study all of these things together. And remember, we always focus on the concept first, followed by the hands-on, because then just knowing one of them these days is not enough. So we'll get the conceptual understanding so that we have the comfort. We'll understand an application of that, because just knowing the concept doesn't matter. So let's say if I talk of Black-Scholes, so people will say, yeah, whatever, Black-Scholes matter. But then if we say Black-Scholes is something which you'll use for your daily valuation, Greeks, capital charge, that gives a lot of motivation to study and then build a model, isn't it? So we will study it from that perspective. So for everything which we do, I assure you, I will give an application for that. I'll keep on sharing my project experiences as well, which will hopefully will add value. And feel free that you can also add your experience at that time. System configuration to work on Python. So Vishal, no specific configuration. The good thing is Python is extremely light. So that way it works everywhere. And there are many, many IDEs out there. Is it possible to move into risk analytics? Definitely. It is definitely possible to move into the risk analytics space, because then the thing is Python is something which companies are using extensively. I use it extensively on our assignments as well, which are consulting engagements. So with my experience and my current experience, I can say with confidence, yes, you can move into the risk analytics space. And the thing is, we do a lot of conceptual discussion as well, isn't it? So then you can, so that becomes like a full package. You know the concept, you know the application, and then you'll be hands-on as well. So we try to address all the three so that you're well placed for these kind of analytical roles. Yeah. Any more thoughts? Any more questions? And that way, I mean, the classroom also will be very, very interactive like we have now. I keep on asking a lot of questions. If there are no questions from the candidates, I start asking questions because then my job is to ensure that everyone is comfortable with the concept, and then we go ahead. I tell candidates, you ask me the same question 3, 4 times, I'll answer it those many times. But then the thing is, conceptual clarity is very, very important. Without that, just building a model doesn't make sense. So my focus is always knowing the full thing. Even if it takes time, let it be. We can have one additional weekend if need be, but then conceptual clarity is something which I always push for. Because finally, on interviews or in the long run, it's always the conceptual clarity, which is the subject matter expertise, which pays. And then, of course, our hands-on thing we'll do together. So that way you'll enjoy. Yeah. Any more thoughts? Any more questions? Let me see if I missed any question. Uh, no, so you don't require any formal qualification for this. So that way, no specific qualification required. We'll do things together. If you know basics of finance, which I figure you already know because you have answered a few questions earlier as well. So those fundamentals are sufficient. And that way, I mean, we can learn that from a Python implementation. So nothing else that is required. No, no prerequisites. Yeah. Anything else which I can answer? Uh, Let me just scroll up to see if I miss some. Um, there's a question. How much of? No. So say not much of statistical knowledge is required. No, no. The required things from statistics we'll cover in the session. So that way we will cover the required bit. So anything from probability distributions which we need or any statistical ideas which you require, we will cover it on the go. So no background required as such. And that way, at the right points in time, I keep on recommending additional reference material as well if need be. But then the good thing is once we do a lot of things in class together, uh, catching up on any additional references becomes easy. So that way, no prerequisite on statistics. We'll do the needful. Yeah. All right. Great. So any no. So I think our questions are done. Great. Great. So thank you very much. Uh, would we? Yeah. There's one more. Yes, we would be starting from basics. So Sayed, the first question which we'll actually discuss is what is Python. So that way it will be from bare basics. So that way, I mean, you won't need to have a background in Python as such. Uh, how many sessions? So sessions will be covered over 6 to 7 weekends. So that way, I mean, we will do from basics. So we don't need to be stressed at all. And we'll do a lot of simple hands-on first before we get on with actual finance stuff. So I can say that maybe the only the very first session, we won't have any finance specific thing, but I can assure you all of the following sessions, there'll be a lot of financial stuff which we'll do together. Yeah. Yes. So that way, I mean, the things which we discuss in the session sprints, that is something which gets uploaded on the student portal. So the video plus any kind of workings which you do, they will get uploaded on the portal, which you can run through. Yes. So that can be used for revision as well. And that way, since it's the recording also available in case a candidate is traveling on one of the days, they will not miss anything. They can still come back, go through the missed part, and they're good. And that way, I tell candidates that definitely revise things because then certain concepts are new. And any questions, we can always discuss that on the following weekend during the class or maybe after class, or if possible, we can do it during that week. We can talk offline as well. So that flexibility we have. But rest assured that conceptual clarity will always build. Without that, we'll not go. All right. Great. Yeah. So any more questions that I can answer? But good. I like this interaction because then that actually helps resolve all the questions, queries also. And the live sessions also, we keep on doing the same. All right. Great. So if the questions are done, I think we can safely sign off now. Yeah, I think our questions are done. I haven't missed anything, isn't it? No, I haven't. All right. Great. So thank you so much.